Hello, and welcome to the property market update for Tasmania from realestate.com.au. I'm Luc Redman, an economist here at REA Group, and I'm going to be taking you through the market and what's going on and the economy more at large. To that end, we're going to start with economic conditions, then move into the current housing market and where we currently are in a bit of the state of play. Then a very topical area at the moment is investor activity and the budgetary changes. Then we're going to finish off with a bit of an outlook from REA and our view of where the market is currently going. Firstly, economic conditions. So the kind of key theme at the moment within the economy is inflation. Inflation's been pretty persistent for some time, and it's very sticky right now. So sticky essentially means inflation is not really getting down to the area that the RBA and we kind of want in the economy, that grey area that you see on the chart below, that 2 to 3% band. And that's been the case for some time. So pretty much ever since 2022, we haven't really reached the target band. So that's coming up to almost 5 years, 4.5, 5 years. And what we're essentially seeing here is when we look at this graph, we see the red line, which is headline CPI, which is essentially what households tend to feel from inflation, which is a lot more volatile. So it's essentially takes all of the price movements within the consumer price basket. So that's essentially if we take a general idea of a household within the economy, the goods and services, the things that they buy, how much those prices have essentially gone up over time. What we're looking at with the light blue line here is essentially the trim mean, which is the RBA's preferred measure of inflation. Essentially, that takes the top 15% of price movements within the basket and the bottom 15% of the price movements in the basket and removes them. So it tries to take out any volatile price movements. So think when seasonally with fruits and vegetables, certain times of the year they can be very expensive and they can be very cheap. And essentially that's what the trim mean tries to account for, any sort of big jump in prices. What we're looking at with the dashed line for the dashed blue line and the dashed red line is the RBA's forecast for inflation. So when they release the statement of monetary policy at the board meetings, when they make the decision about what interest rates are going to do, they tend to sometimes release an outlook for inflation based off their modeling internally. And what we currently see is inflation isn't going to really return to the target band until about mid 2027 off their current assumptions. And that's a little bit concerning given that one, households are currently under a lot of pressure, and two, that means that we might potentially see higher interest rates still. The main driver behind this has been domestic factors, not necessarily the war in Iran, even though that hasn't helped the situation. It's actually been a lot of domestic factors in the Australian economy. So what we're currently looking at here is headline CPI, that red line that we saw before, but split out into two analytical series, which essentially are non-tradables, those domestic factors and domestic prices that are driven by Australian factors. Think electricity, rents, hairdressers, even pharmaceuticals that are driven by domestic policy or domestic markets, and tradables, which are essentially driven by international competition and international prices. So those are kind of the things that we import and export, and we don't really have, it's a bit more of a free market, and there's not a lot of policy controls around them. Tradables, the light blue line here, is essentially only a third of the CPI basket. The other two-thirds are made up of non-tradables. What we currently see here with non-tradables, that red line, that two-thirds of the CPI basket that households consume, that hasn't really entered the 2 to 3% target band that the RBA is after. In fact, since it kind of started easing interest rates back in early 2025, it's essentially accelerated a lot more. And we're currently sitting at just a bit below a 5% annual growth, which is quite above the 2 to 3% target band that we see. What we see with tradables has been over time, essentially it's come down quite a lot as the COVID shock eased and supply came back online within markets and supply chains restored. And essentially it kind of went well below the target band. Sorry. Essentially, when it's that low, it made our domestic inflation problem kind of be masked a fair bit. The RBA was aware of the problem, but they were hopeful that essentially that a lot of things would move in a similar direction. But what we've actually seen is with that easing, those um, domestic factors have increased, and we haven't had as much downward pressure from tradables as we'd like. And when the Iran war broke out, we saw that big spike on the right here, which has come down a little bit from policy responses and a bit of easing in the oil price. But ultimately, we're well and truly above the target band at a headline level and continuing to be at an underlying level. That essentially meant that the RBA had to hike interest rates again. And what we're currently looking at is mortgage rates for new owner occupiers as a variable rate. And that currently sits at about 6.23%. Obviously, it moves around depending on the borrower and the land to value ratio that they're willing to put up. But essentially, this is the average that we kind of see across the economy. In recent history, it's been really, really low from 2020 until now. And even going back further than that, since about 2012, 2011, we haven't really seen mortgage rates as high as this since then. That's meant that there's been a big hold up in terms of borrowing because the cost of borrowing has gone up quite substantially, which is aiming to bring that inflation back into the target band, but puts a lot of constraint on the housing market and the economy because essentially it's a lot more costly to invest. When the RBA's put up interest rates, essentially there is a relationship between interest rates, unemployment, and inflation. There's a key one between unemployment and inflation that when inflation tends to go up, sorry, unemployment tends to go down. And when unemployment tends to go up, inflation tends to go down. And that's kind of an empirical economic relationship that we see. So what we're looking at here is quite a long historical timeline of the Australian unemployment rate. That goes back to about the 1970s. And what we currently see where we are at on the far right of the screen is quite a low level by historical standards. There's been several economic shocks and recessions and certain things along this timeline. But where we're currently at now is quite a strong area, it's quite a low level and strong labour market, which essentially has meant that wage growth has been quite strong, which is a good thing, but has been eroded quite strongly by the higher inflation. So that's kind of what the RBA is trying to pull back without hurting the labour market too much. So that essentially we get all these household income gains without needing to kill the economy at the same time. The light blue line is the RBA's forecast, similar to what we saw in the previous forecasts from the RBA. And they essentially expect that to rise as they kind of put the economy into more of a contractionary stance so as to slow demand and allow supply to catch up. So that we kind of reach a bit more of an equilibrium. That light blue line is still going to be quite low by historical standards, pretty much only outbeaten in recent history by pre-GFC and the response to that. But essentially, it's in a pretty good spot, all things considered. But that has been partly, at least until quite recently, driven by public sector demand. So up in the last 12 months or so, the private sector has taken over a lot more of the growth, but a lot of the gains that we saw within the unemployment rate and those sorts of things after the after the COVID settling, after we had the shock to the private sector, has kind of been mostly public sector driven. What we're looking at here is GDP growth, essentially kind of the preferred measure of how the economy is going. We see the black line here that is essentially the total growth of GDP in the economy of Australia on an annual basis, moving across each quarter within a year. So we go back to 2015. What we see in the red is net exports, so essentially our exports less imports, the Australian economy. Australia exports or has tended to export quite a lot, and there's some other things that are added in there that make it essentially contract in recent times. Private sector is the light blue, which ultimately is ideally the main driver of growth. And in recent years, it has been a key factor of growth. But the public sector, at least since 2022, 23, has been propping up the private sector because essentially we've kind of had a bit of a slowing in growth. And that's going to probably continue for a while. The big uptick that we're seeing in the private sector right now, the last four columns that you see on the right of this graph, they're essentially mostly data center driven. So when we consider data centers, there are these big construction investments that have quite a big capex phase, and there's a lot of demand in the global economy for them right now that I'm sure everyone is aware of with the AI trend. And we're starting to see that come into Australia quite strong. We expect that to kind of continue and be the main driver of growth, but it has basically been the key reason that GDP has accelerated in the last 12 months. Looking to Tasmania now, more specifically, and population. Population growth in Tasmania is a very topical area, and that's partly because of how slow it has been in recent years and how much older the population is. So what we're looking on the left here, we've got two graphs essentially, and on the left, we're looking at year-on-year annual population growth. So the red line is Tasmania, and the grey dashed is Australia. What we currently see is Australia's kind of reached it back to its steady state level of that 1.5%, which we essentially had a drop off in 2020 when COVID occurred and the border shut, and a quick rebound in 22, 23, 24. That um, lag in demand, which essentially resulted in the large fluctuation in the year-on-year price growth, is kind of settled now, and we're at this 1.5% growth, which is basically a long run point that we expect it to maintain to. Tasmania is a bit more unique. So Tasmania prior to COVID and even in the early stages of COVID had quite a strong population boom, which was a little bit unexpected in the economy and was quite beneficial for a period of time. So we kind of see that in the components of population growth on the right here, these column graphs. So these are broken down into three areas: natural increase, net overseas migration, so those that choose to live in Tasmania and from overseas, and those from Tasmania that choose to live overseas within the period, and net interstate migration. Net interstate migration is basically someone from Tasmania choosing to live in another mainland state, or someone from a mainland state choosing to live in Tasmania. So what we currently see is when you look back from 2000 until now, is Tasmania's net interstate migration has tended to be pretty low, particularly since about 2005 and even slightly negative. From 2015, there was actually quite a large influx of people into Tasmania from other states, be those people returning and then or people looking for a sea change, which tended to prop up that strong demand of over 2% or around over 1.5%, which you see from 2016 on the left-hand graph to 2020. In the start of COVID or during a bit of COVID, there was a large influx, which is essentially reversed now, which we see in the negative purple bars, sorry, on the right. That's essentially been a big lag and a big drag on Tasmania's population growth, which now sits at about 0.5%, which means demand population growth and demand for dwellings is very subdued compared to other states. While it's recovered slightly as the net interstate migration's kind of um, reached more of a steady state, it's probably more closer to the long run population growth level that we're probably going to expect from the state. The other interesting thing about Tasmania is the red bar that you see there, the natural increase, which is essentially those people dying versus the number of people being born within the state and how that's changed over time. You can see that it's evolved from being a relatively strong contributor to population growth to contracting quite a lot. And that's because of the aging population in the state. We're essentially seeing a lot more older people relative to babies, and that's contracting so much so that the only driver of population growth at the moment is net overseas migration, and that has meant, and it's even by other state levels, a very low level. Now moving on to house prices and the established market. Tasmania's had a recovery in prices over the last 18 months, which has been a bit of a different story what we've seen in a lot of other markets. So what we're looking on the left here is price growth since March 2020, where there's been quite strong price growth nationally. On the right is comparison cities, so Brisbane, Sydney, and Melbourne. And what we see is for Hobart, its price growth levels have been slower than the national average. But for the rest of Tasmania, for everywhere else outside of Hobart, in the north of the state, the northwest, the southeast, the east, the west, we've seen it particularly since the expansion of the 5% deposit scheme accelerate quite a bit. It also didn't really have as much of a decline over from 2022 when people left the state as Hobart did. And essentially it's meant that price growth went basically sideways and has now gone up. Ultimately, prices within the state are around over 50% higher than what they were in 2020, which means prices levels are quite strong. When we split out houses compared to units for Hobart, essentially they've still lagged in both areas to the national average, but in Hobart in particular, the unit growth price growth level has been more closely aligned to the national unit price level than what houses have. Houses in the rest of the country have grown a lot more strongly than they have in Hobart, but units have grown relatively about the same. And it's pretty much driven by the affordable end of the market. That's why we've kind of seen the unit level be very close there. The affordable end of the market, the low tier, that red line that we're looking at here, versus the mid tier and the high tier, has grown a lot more and a lot faster than the high and the mid tier. And that's kind of been the case a fair bit nationally, in particularly in Melbourne and Sydney, and a lot of regional markets where price growth has been quite strong. Essentially, um, there's been less ability for households to bid up prices, and they essentially are substituting further down towards cheaper prices and bidding those up a lot more. So we kind of see that the lower price level of the market has grown a lot more than mid and higher. That's been a bit of the look up until now. Now, there's been some pretty strong changes within the housing market in the recent 2 months, 3 months. There's obviously a lot higher interest rates, as we've discussed, and there's been a fair amount of tax changes from the federal budget, and we'll talk a lot more about that at the end. But one thing to put into context here, which is quite interesting, is the share of houses that are selling below the original asking price. So when you consider Tasmania, on the left here, the red graph, over time, since about it's there's been quite a high proportion since about 2015 of houses that would sell below the original asking price. That was trending down a bit as we saw that population growth occur into the state, and then kind of reached just a bit more of a steady state in 2018 to early 2021. Then, as a lot of inflationary pressures increased and people had more money in their pockets, there was a lot of bidding up of prices for houses in Tasmania, and we essentially saw only around it bottomed out at about 10% of houses in Tasmania sold below the original asking price. That inflationary pressure kind of brought it back to the more steady, the easing of that inflationary pressure, sorry, brought Tasmania back to more of a steady state, which you kind of see between 2023 and 2025. Now, with the recent changes, we essentially are seeing a slight uptick, and you can see it on the left, on the right here with the national graph in the light blue, a slight uptick in those that are selling below the original asking price, which is probably the thing that you're seeing on the ground a fair bit more, where people aren't willing to sell at certain price points. That hasn't really been the case too much in Tasmania as yet. We're still selling a lot a lot above the asking price, with about 2/3 of properties still selling at that price point. The interesting thing is the main driver of that has been a fair amount of the shared deposits, or sorry, the low deposit schemes. So the state government's 2% deposit scheme and the federal government's 5% deposit scheme, which have essentially meant that lower level that we spoke about before has had a lot of prices above what the original asking price is. Moving on to rental availability. Hobart's a very rental constrained city compared to the other capital cities and regions. We see that in the red line on the left here versus the rest of Tasmania, which is still quite low, but almost on par with other regional areas and capital cities of Australia. Ultimately, what is considered as high rental stress areas is anything below that 2% amount, which Tasmania has been relatively consistently below that 2% of rental availability for quite some time, despite a slight uptick when we saw quite a big exodus in interstate migration in the state, which you see that spike of the red and blue line in mid 2023. There's been some relative improvement since 2026. That's kind of occurred nationwide. There's a bit of seasonality with that, with heading into winter, there tends to be more rentals available, people are less likely to move, and those sorts of things. But it seems to be a little bit more dramatic than what has been in the last year or two, in Tasmania in particular, in the last year. But nationally, it's been since the last year or two, or it's since about 2022, 2023, there's been quite a big jump in the vacancy rate. And the factors behind that aren't quite clear yet, but we'll see over the next coming months whether there is any relative release of pressure for rentals. Ultimately, that tight rental market has meant that rents have been rising quite dramatically. So they tracked sideways in 2022, 2024 when we saw that big increase in the rental vacancy rate, but they're ultimately quite elevated and relatively unaffordable for the state. There are lower incomes in Tasmania relative to other states, and that essentially means that there's a higher proportion of wages going to rents than in a lot of areas of the country. So Hobart's currently level with the average of other regional areas in Australia, but those regional areas do include major cities like Newcastle, Gold Coast, and those sorts of areas where we essentially kind of see they're a lot larger than Hobart, but essentially just don't have Hobart just essentially does not have the supply to match those areas where there is quite a lot more demand. The rest of Tassie is a little bit lower than Hobart, sorry, and that's essentially the case that we kind of tend to see nationally, except for that on the right we see with the purple and the green lines, a near touching during COVID when a lot of people were leaving places like Melbourne and Sydney and moving into regional areas, and we essentially saw a lot of demand for those properties. Moving on to something a little bit more interesting, because of the 5% deposit scheme and the 2% deposit schemes that we're seeing, there's been a lot more demand for more affordable LGAs. That's kind of seen a large increase in inquiries per listing in certain areas that are being considered, well, previously have been a lot more affordable, but that means prices have been bid up a lot more. So places like Devonport, local government areas like Devonport, Brighton, and Glenorchy and Burnie, and even the Derwent Valley, have seen almost a doubling in inquiries per listing in the 12 months to June compared to the 12 months prior. And that may have slowed down a little bit lately as investors have pulled back, but ultimately they're still at really high levels than what we've actually seen previously. Looking at listings, basically, this is only looking at Hobart listings, but new listings each month are kind of still tracking along with what we've kind of seen as recent history and the long run average that we tend to see. So that means there's still a lot of demand in the market to sell a property. But whether the seller's able to meet a buyer at the price point that they want is a bit of a different question. And that's kind of tracked about the same since the start of the year. There was a little bit higher in April, but we're essentially at near average levels. Investor activity. So the main thing for investors, which we all know, is the government policy shifts that have occurred. They're going to probably tend to skew more towards owner-occupier sales over the short to medium term, and we'll see a higher proportion of owner-occupiers and less likely to see more investors in the market. But essentially, the capital gains tax discount is reverted back to its old indexation model, which will start in financial year 2028. Combined with this, there is now a minimum marginal tax rate on any capital gains that are made. And that's the idea behind that is essentially being to reduce strategic realized gains, which doesn't tend to happen in the property market. but does tend to happen with shares and other investments like that, where people will go into retirement and strategically realize when they sell certain amounts to avoid tax. The transition to the new methodology will occur on July 1, so the start of FY28. And essentially, at that point in time, any unrealized gains can either be assessed at the value, so a valuer will come and have a look at the property in some time prior to that date and will say it's worth this much. And the owner can then essentially say, all right, I will take that amount under the 50% capital gain. So not realizing the gain at that point in time, but having it recorded. And then any gain above that amount from there on in will be at the indexation point, or they have the option of choosing a pro rata share of holding time. So pro rata essentially means they will purchase the property, they've held it for 5 years, 5 years into it, they essentially have this transition from the 50% CGT into the indexation, and then they sell it 7 years of holding. So 2 years in the indexation, 5 years in the 50%, and they will get a proportion of the gain at the 50% discount and a proportion of the gain at the indexation level. New builds can choose between either of these two discount methods when they sell, and the principal place of residence is still CGT exempt. Negative gearing has kind of shifted from deducting losses from current income to deducting losses against future property income gains. And that's for established properties or property portfolios. So you can do that across a portfolio. So that's not necessarily going to directly deter too much of portfolio property investors that can probably offset new purchases with income from other assets, other property assets. But it may slow introduction of new investors into the market that can't necessarily afford to offset that amount of that loss-making amount off their tax. Commercial property and new builds can still claim the old negative gearing rules. So there's a bit more of an incentive there for investors to move that direction if they are willing to put up that capital. The purchasers prior to budget night are still able to claim the negative gearing until they sell, or until they are no longer a negatively gearing and they're going into positively gearing. The other thing is the AUSTRAC anti-money laundering requirements that all real estate agents are no doubt across, they've come into effect. And that's essentially to try and prevent money laundering within the housing market. And there's a lot of regulatory requirements for that. Looking at the CGT changes, it's an interesting move from the federal government. The reason why it's interesting is essentially CGT gains are the change back to the indexation method is a lot more technical than arbitrary. So when we kind of consider the 50% discount, it's pretty fundamental. You have basically the tax rate that you're essentially going to pay, or the marginal tax rate that you're going to pay. Sorry, the effective tax rate that you're going to pay. Whereas the indexation method is a little bit more moves with the economy and with the market. So what we're looking at here is those residential property investors that made a capital gain since 2016 within the Tasmanian economy, in the Tasmanian housing market. And essentially what we've evaluated is whether they would have paid less tax under an indexation model versus under a 50%. And where you see this is the proportion of sales, sorry, that occur within each quarter. And essentially we take the proportion that would have been better under the indexation versus the proportion that would have been better under the 50%. Looking at this graph, 50% discount, a lot more people benefited from the 50% discounts, i.e. they paid less tax. But that's not true for everyone. And that's kind of going to be the case with housing market cycles and seeing how these sorts of things evolve. And it's also particularly the case when you consider how and when purchases and holding times occur and the cycles that they happen in. So it's a lot more about the timing in the market and the movement of inflation than whether someone pays more or less. Investors have been a big story in Tasmania. They were really strong and had reached a new high in March, but essentially and had grown since about the start of 2025 as the more affordability within the Tasmanian market grew. That's meant that investors have also become a higher proportion of sellers. So that growing level of investors in Tasmania, and we're looking at Hobart here compared to the rest of Australia as as an investor share of new listings. We've seen a really big uptick since budget night in those investor share of new listings. But for Hobart, that's been a gradual trend since about 2020, as you can see. So that's been a growing share of where these new listings tend to be coming from. And that's probably going to be the case for at least some time into the future over the next 6 to 12 months. Looking forward, essentially the housing market in Australia and Tasmania essentially is just not building enough houses. We're not building them in the right places and we're not building them fast enough, and nor are we getting the approvals to do it. What we're looking at the left here is dwelling completions for Australia, and the horizontal line that you see there is the National Housing Accord, 60,000 houses that basically are going to support the National Cabinet reaching the target of 1.2 million homes. Tasmania's share of that is to reach 1,200 per quarter. And at the moment, we're well and truly below that, both at a national level and in a Tasmanian level. In fact, Tasmania slid quite a fair bit since 2023. That's kind of going to continue at least over the near term. Tasmania has quite a strong pipeline of a lot of capital works, be that Marinus Link, Northwest Transmission Distribution, Macquarie Point, a lot of AI data centers that are coming online, which are essentially going to mean that there's a lot more competition for labor and resources within the state. And that's going to mean that we're going to probably see some sort of slowing in dwelling completions to continue. Ideally, you would see some policy responses that will mean that we bring in more houses, be that a removal of stamp duty for land tax and other policy responses that reform zoning to make it a lot easier to build houses. But ultimately, those are required from policy responses, which may or may not happen. Looking at the cash rate now and the RBA's potential decision, economists kind of disagree on the cash rate at this point in time. Inflation data will kind of determine who is right. So we kind of have three forecasts here in the dashed lines. So one is what came out from the RBA and their expectations of the cash rate, the light blue line. The green line, which is essentially Westpac, the bank, their forecast of where they expect the cash rate to go, and market economists, the purple line, which is essentially a survey of a lot of market economists and what they think will occur. As you can see, the next movement is quite a bit different in the gap. Westpac expects it to increase, or at least in the next couple of meetings to increase by one, potentially two. Even the RBA expects themselves to increase it to some degree. When that occurs is still uncertain. And market economists essentially think that there's enough of a contraction within the economy that we can just hold rates where they are and inflation will sort itself out. They all agree that in the future they will cut rates, but the level of which they cut them and where they cut them remains to be seen. But we probably won't see any rate cuts without any big global shocks or big economic shocks in Australia until about mid to late 2027. Taking that all as it is, REA, we still have quite a view that there's a lot of noise happening at the moment. And rightly or wrongly, that's, that's essentially going to mean that we're still going to continue to see price growth within house prices. There's not a lot of things to address the underlying fundamentals of supply and demand. And currently, we have a lot less supply than we have demand. And that's essentially going to mean that prices continue to rise. Looking at Hobart, we expect it to grow by around 7% in 2027 and finish the year at about 6. So currently it's sitting around 8 to 7 or 8% year to date. And we expect that to come down just a little bit more before the end of the year before we return back to price growth. And that's pretty much mostly due to the affordability angle of Hobart and the relatively strong capital projects that are coming online within the state that we expect to meet in slowing of new supply coming online. That's all for this presentation. I hope you enjoyed it. I hope it was informative. Thank you very much for your time and have a lovely day.